After year-end, not every surprise changes the accounts, but every surprise demands attention. Adjusting events say, you already had a problem. Non-adjusting events say, congratulations, now you have a new one. Let's look at a classic IAS 10 example.
Imagine we are being sued. At year-end, December 31st, the court case is ongoing. We think we might lose. In February, before we sign the accounts, the judge rules against us and orders us to pay $1 million.
Input received. The judgment timestamp is February 15th. Therefore, the cash outflow is a Q1 event of the new year. I shall record this transaction in February. The December accounts remain pristine.
Rob is actually making sense. The gavel struck in February. The sound rang out in the new year. Why would you punish the December tablet for a February defeat? That is rewriting history.
No. Think about why we lost. The condition, the negligence, or breach of contract existed before December 31st. The court ruling in February did not create the liability. It just confirmed the amount of a liability that was already there.
So, the wound was already inflicted, but the soldier only fell later?
Exactly, Marcus. The wound was there at year-end. The February ruling is just the doctor confirming it is fatal. Because the condition existed at the reporting date, this is an adjusting event. We go back and change the December numbers to include the debt.
Reevaluating. You are suggesting we perform a retroactive data patch. This violates the linearity of time. However, if the probability of outflow was effectively 100%, based on the logic of the law, the variable was merely unresolved.
Right. We adjust the financial statements as if we knew the outcome all along.
I do not like this. It feels like admitting defeat before the battle is lost. But if the wound was already rotting, fine. I will chisel the debt into the old stone, but I will do it angrily.
I will update the spreadsheet, but I will add a sad emoji to the cell.
Scenario 2. Our inventory is sitting safely in the warehouse on December 31st, valued at $5 million. On January 15th, a massive fire burns the warehouse to the ground. Everything is gone.
The central storage warehouse is burning. Ugh. All the inventory. How could this happen?
Disaster! The gods are angry. We must destroy the December tablets. We possess nothing. We are ruined. Strike the $5 million from the records. We are beggars.
Affirmative. Asset value has been reduced to 0. Updating December balance sheet to reflect current status. Pile of ash.
Stop. Both of you, stop. Do not touch the December numbers.
Query: the asset does not exist. Listing it as an asset is a logic error. It is a lie.
On December 31st, the reporting date, did the warehouse exist?
Yes, it stood proud.
Then the condition arose after the reporting period. This is a non-adjusting event. The balance sheet must show $5 million because at that specific moment in time, it was there.
But the users of the financial statements will read asset at $5 million. Then they will look out the window and see smoke. This will generate a trust error, 404.
That's why we add a disclosure note. We tell them in the notes, in January this asset burned down, but we do not change the primary numbers.
So, we keep the statue on the pedestal, but we put a small sign at the bottom that says, "Warning, this statue has already crumbled to dust." Roman bureaucracy is strange, but modern accounting is madness.